Okay, now we're going to look at B. Presented below is a selected transaction for Nellum Products Proprietary Limited. Sold office equipment for $48,000 that was purchased on the 1st of January 2010. The equipment cost $120,000. Now the useful life of 5 years with a residual value of $25,000 at the end of its useful life. The company uses straight line depreciation method. The office equipment. Prepare the relevant journal entries to record all the transactions on the above dates, including entries to update depreciation. The financial year for Nellum ends on the 31st of December. Narrations are not required. Okay. So let's have a look at my depreciation calculation. Annual depreciation. Let's go B. What have we got? We've got a machine. The cost was $120. My residual is how much? 25. And my life is 5 years. So how do I calculate that? Annual depreciation equals cost minus residual divided by life. So I've got 120 minus 25 divided by 5 years equals, that's 95 divided by 5 is 19,000 per annum. So that'll be my annual depreciation. Now I bought this on the 1st of January 2010 and I'm doing the calculations for 30th of June 2014. So, now it asked me to do the journal entries. I should have started this on a clean page. Let's flip over to a clean page. I'll just put a note here. There's a good chance you might have to do a journal entry, yeah. Well, I might have to. No, that's right, no promises. If I don't make any promises, I can't disappoint anyone. No, it's not my own. Alright, so that's my depreciation calculation. Now I need to firstly record the purchase of it because it's telling me all relevant journal entries. So let's record the cost, which would be on the 1st of January 2010. What did we buy? We bought some equipment, didn't we? Office equipment. So my office equipment we purchased for $120,000, and I'm going to just assume that I paid cash for it because I'm cashed up. Okay. Now I've got 2010 was when I purchased the equipment. So depreciation from 2010 to, let's go for the 31st of, so 2010, 2011, 2012, 2013, so 4 years. So I'm doing this to the 31st of December, so I've got depreciation expense, which will be 4 years, so 4 years times $19,000, which comes in at, how much is it, 86,000. Is that right? 76,000, that's right. And my accumulated depreciation would be 76,000 as well. And now I'm going to do the depreciation for the 6 months to the, what is it, to the 30th of June, which will be half of that. So it'll be half of that, so depreciation expense is 9,500 and accumulated depreciation is 9,500. Alright. Now we're talking the sale. So that's my journal entries to that point. So I still haven't finished my journal entries. So my sale of equipment calculation. So my sale calculation. Purchased it for 120,000. My accumulated depreciation should be 76 plus 9,500, which will make it 85,500. There's 85,500. So what we call is my written down value. Which I abbreviate to WDV, is 14,534, 500. So we sold this office equipment for 48,500. So proceeds 48,500. That means we have a gain on our sale of $14,000. So the journal entry for disposal now that's a cash figure, so let's put my cash figure in first. Actually no, I'll get rid of my depreciation first. My depreciation, accumulated depreciation. My accumulated depreciation is, well, I say 85,500, so I'm going to debit that. My cost, it's 120,000, I'm going to credit that. Disposal proceeds, $48,500. Gain on sale. $14,000. Now, just so you know, if I was balancing my journal, this comes to 134,000. You don't have to do this last bit. 5 and 5 is zeros. What do we got? We've got 9 and 5 is 4. And 50, what did I do that? 9, 13. So you know your journal balances. And the last question is C, which is identify 2 fundamental qualitative characteristics of financial reporting. There is only 2. And we have faithful representation, yeah. And relevance, as mentioned. So the thing is fundamental qualitative characteristics. There is enhancing qualitative characteristics and fundamental. Oops, slide that up.